Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, feed fanatics and grain geeks. Welcome to another edition of the Grain Feed, brought to you by EverAg. Each week, we bring you updates on the markets with unique perspectives from an amazing team of analysts with the intention of helping livestock producers and dairy farmers manage risk. I'm Phil Plourd, filling in for Jim Matthews, who's on assignment this week. That's the bad news. The good news is that we have two exceptional panelists on board for the ride today. First, from our Platteville, Wisconsin office, we have Britt O'Connell, who heads up our Grain Foundations business. Hey, Britt.
Hey, Phil.
And second, from the Madison, Wisconsin area, we have Katie Burgess, who works with dairy producers and commercial clients. Hey, Katie.
Hey, Phil.
Paige, let's go ahead and timestamp this episode. It's about 10:05 a.m. Central Time on Thursday, February 15th, the day after Valentine's Day. Not a lot of love in the markets, though, if you are rooting for higher prices. We have nearby corn trading at about $4.22 per bushel, down 11 cents from last week, and we keep making new lows. Soybeans have slipped below $12 per bushel. Last trades in the $11.67 area. That's down 27 cents from last week. Soybean meal, $343 per ton, down $4. Class 3 milk, $17.42 per hundredweight on the 6-month strip. That's down 11 cents. And just to keep saying the word down over and over and over again, Class 4 milk on the 6-month strip is at $20.33 per hundredweight, down 9 cents from a week ago. All right, guys, let's get into it. Britt, this morning, USDA Ag Outlook Forum. We have our own Mike McGinnis there on the spot in Washington, D.C., flashing out the news at what was 6 a.m. Central Time this morning. At a high level, didn't look bullish to me. USDA's first pass at ending stocks for the next crop year for corn, big numbers. For soybeans, big numbers. Hard to see what was bullish in that. Any first impressions for you? Anything catch your eye out of that Ag Outlook Forum?
Yeah, Phil, it really is, kind of more of the same, if you will. We continue to just see a bearish tone to the grain markets here. USDA did come out, and while this is not the official prospective plantings report that comes out at the end of March, they did say that they expect the American farmer to plant 91 million acres of corn. That's very much in line with expectations. And on the soybean side, 87 million acres, which again is in line with expectations. But as we look at ending stocks numbers, yield projections continue to grow. We continue to see somewhat stagnant demand. And so we see those ending stocks projections for the 24-25 production year just continue to grow. And that's really going to keep this market trending sideways at best to lower. End of day, we don't really see anything on the horizon that's incredibly bullish, albeit the bulls are certainly continuing to look.
So you had 2.532 billion bushels corn ending stocks. The trade was looking for a little bit more, but, we're going to be at 2.2 billion-ish for this year. So we're growing from a big number. Stocks to use like 17%, if I understood correctly. That's not a $5 corn number, right?
No, it's not, Phil. And, as we look forward, we continue to believe that this market will continue to slide. 17.2% stocks to use ratios just does not allude to anything north of $4, quite frankly. And so while this is great news for grain buyers, especially as milk prices continue to see some pressure, for grain sellers, this is going to be a bit of a challenge. They're moving into a very different environment than they've been in for the past 3 years. And as a result of that, they're really going to have to, reassess how they're viewing these markets.
And we're going to come back and talk about the profitability for growers in a minute. But let's talk about the profitability for feeders and dairy producers. Katie, what's been on your mind lately? What are you looking at?
Yeah, especially as we're watching some of these forecasts come in for less expensive feed this fall. I think from a producer perspective, it's a good time to think about playing some defense in terms of where milk prices are trending right now. Let's start with the class 4 side, which is generally pretty good news for dairy producers. Deferred futures are above $20. Some months even have $21 prints. So the numbers right now are looking pretty good. And if you go out to look at buying some DRP right now, your trigger price would be over $20 a hundredweight. So, $20 is generally a good number, especially if we expect feed to be cheap. So it's been my recommendation to folks to start looking at getting some coverage on out there. And On the class 3 front, the numbers aren't quite as rosy. It's closer to about 1750 DRP floors for the second half of this year. But with more cheese capacity that keeps coming at us, I still think it's a good idea to go get some coverage on that when we look at less expensive feed, some $20 class 4 coverage, some $17.50 class 3 coverage. It feels like those are numbers that can at least work together to help ensure hopefully a profitable margin picture later this year.
Yeah, it's been kind of eye-opening the past couple of weeks to look at, the cheese export rhythm, if you will, and how prices behaved in early 2023 and think, we could be repeating the same thing today, right? Last year, start off low, exports came on, we went high on cheese prices. The exports disappear. We went way low into June, which no one really had. And then we bought some more exports, and then we went up. But there were some pretty low numbers that just sort of emerged in Q2 of last year. And it was a roller coaster ride, but it wasn't great. And then Q3 was kind of a disaster. And while I think we're a little bit more friendly to the markets than that, the same, it's export or perish, right? It's been one of our mantras for the past 18 months, and we're still in the same place. And this week what are we hearing this week, right? We're hearing about a little backwash, right, on exports.
That's right. I think that's why it's so important right now for producers to kind of be playing defense. It's the reason DRP has been so popular, and it's my continued strategy of choice for this year. I mean, from a milk supply side, it's not like we're making extra milk in the US. Our milk supply is down year over year. That's true internationally as well. But demand just isn't there. So I like the idea of, getting a price floor in place for milk later this year. And then, root for it to go up, but at least you're protected because demand has definitely been uneven.
Yeah, there's no question that the supply side, in any other situation, it would be potentially explosive. Milk production down in the US, milk production down in Europe, milk production so-so in New Zealand. If the demand side doesn't show up to work, we're not going to get much done, right?
That's true.
Britt, seen some things on cost of production for grain growers. So we are seeing prices ratchet down. Well, ratchet down. They've come down quite a bit over the past, 3 to 4 months. From a grower's perspective, are we starting to see some are costs coming down commensurately? How are we looking at the potential pinch on the grower side of the equation?
Yeah, so we continue to be affirmed in our opinion that there is a lot of unpriced corn in the country. So the American farmer continues to really be long corn, and that's going to continue to present a problem. Unfortunately, it almost becomes a self-fulfilling prophecy because at some point, farmers need to move grain, whether it be for cash flow reasons or because they've got another crop coming down the pipe at them and they need room to store it. But we continue to see them really hesitate to sell at what will end up being some rather significant losses on the old crop that's in the bin. And as a result of that, many folks are looking past what I would consider still good opportunities in the 2024 crop. Costs of production have come down. We're seeing about $200 an acre or less, and that's pushing corn break evens kind of in that 450 to 430 area in a lot of places. There's still good opportunity out there. We've got, despite, a really ugly week here and continued pressure, December 24 corn is trading 461. So if guys have got on-farm storage and they're able to capture what we anticipate to be wider carries than are offered today, there's still a decent chance that folks can not just, lock in a break even, but they really have the opportunity to lock in some decent margins. When we look at that, we really need to view it in context of the last 10 years, not the last 3. And so while we won't see record margins, we won't see, massive gains, we still have very healthy, respectable margins that still allow an operation to continue to move forward towards their goals.
As Katie mentioned on the dairy side, playing defense sometimes is the best you can do, right? I mean, hey, this isn't exciting, but, 50 cents lower is going to be less exciting yet, right?
Yeah, and I think that's the mindset change that guys really need to make. This shouldn't be a shock. It shouldn't be surprising, and this is not the first time it's happened. And so we need to be prepared. We need to change the way that we attack this market. And as you said, Phil, right now, defense is the best form of offense that we've got. And so buckle up, know your numbers, and let's get after this thing because there is still profit on the table to be had for 2024. We just don't want to put too much lipstick on that pig for 2023's crop.
And, it's a harsh reality, right, Katie? We talk about it in dairy. I think the same thing is true in all ag markets. The market doesn't really care about your cost of production. It doesn't really care. I mean, eventually you can't lose money forever. And, there are consequences to having prices below the cost of production for periods of time. But for 3 months, 6 months, a year, 2 years even, right? The market really we care about you. America cares about you, but the market doesn't really care all that much about your cost of production, right?
That's absolutely right.
I'll add in there too that, I think that's why it's so important for people to be thinking about these risk management things, because if you just wait to see what's going to come in the market, it might not give you these opportunities. So that's why you got to be aggressive and grab them when they're available.
And look, I know it can be self-serving when we talk about these things, but it's also the reality, right? One of our favorite sayings is hope is not a strategy. We can hope all we want if you're a grower of corn that we're going to see a rally to $5, and maybe it happens. I don't know, but it's getting harder to imagine. On the dairy side, it'd be nice to think about cheese demand globally just sort of catching a gear and off we go to $2 cheese. It certainly could happen, but I don't know that sitting around hoping for it is really a good approach.
Yeah, I would double down on that, Phil, and say you're spot on. Guys have really got to engage aggressively in this market because of the opportunities that are ahead of them. And I think the thing that's important to remember is whether you're talking about feed markets or whether you're talking about dairy markets, markets never like uncertainty. And the market is now in a place, particularly in grains, where it is maintaining risk premium for the unknown. And so the opportunities, the best opportunities that live, are back against the forward curve. And so folks who have, been a bit hesitant to be a forward marketer, and again, I think this is true in dairy as well, those are where the best opportunities live. And so you do have to stretch yourself a little bit, look a little further down the horizon and see where some of those opportunities are.
Britt, I think one area of hope out there is that somehow the Brazilian crop isn't going to be all that special. Mike McGinnis, our team, has got some interesting spy photos from South America. And being a roadside agronomist isn't really, but the photos look pretty darn good. Producers in Brazil are adamant that the crop stinks. USDA is kind of held on to a pretty big number. The market seems to believe that Brazil has a good crop. Any views in that department?
Well, I think one universal truth, Phil, is that whether you're a farmer in the US or you're a farmer in Brazil, you always carry an extra measure of hesitation around how big your crop is going to be. And whether that is as a natural hedge or not, we really think that's what's going on with the Brazilian farmer. They're just naturally hesitant, no different than the American farmer was in mid-June about their crop. But we continue to see price pressure. And really, when you read the tea leaves, that's where we need to be looking, is the fact that prices continue to slide domestically in Brazil. And that's indicative of a decent crop. I think the other thing we have to remember is that we're viewing this a year after Brazil produced the largest crop ever, right? And so even if some of the analysts are correct that are using something in that kind of 150-ish million metric ton production, that is still the second largest crop Brazil will have ever produced. So I think that's really big. Moreover, Argentina has come out of their 3-year drought. Last year, they produced 25 million metric tons of soybeans. This year, projections have them at 50 and north of 50. And so net, we are still very likely going to see growth out of South America on the production front. And I think that's what we need to be paying attention to here. I think something that's very interesting, and to me, this is very telling of what's going on here in the U.S. There were 3 cargoes of South American origin beans that were imported into the U.S. in the Southeast here a couple of weeks ago. That's not totally abnormal, but generally that happens, say, July or August. As we get to the end of the production cycle here in the U.S. and old crop beans get to be hard to find. However, this happened in February. And to me, this is indicative of not necessarily a supply issue, but a pricing issue. It means that it is cheaper for end users in the Southeast to bring beans out of Brazil than it is for them to get them across the country. And that's not bullish for beans.
So put your buyer hat on for a second. I know you work with growers primarily, but if you're a dairy producer, a cattle feeder, and you were looking at, the long, being exposed to higher prices, how would you be acting right now? Would you just be kind of hanging out and waiting for the market to come to you? Would you, where would you be sitting in things?
So what I like to tell my guys is let's be opportunistic. We can be patient for once, but we also want to be opportunistic because things do change. And so we don't want to get too far over our skis and go own 6 months of product, but we don't want to necessarily be stuck in the spot market either, because that leaves us exposed to these little headlines and stories that may cause a 20 or 30 cent rally in corn, or, we may see meal up 20 or 30 bucks a ton. And so as you see prices start to go towards new lows, things that we haven't seen since the fall of 2020, go get 60 or so days of coverage on. And then if prices continue to slide, go ahead and get some more coverage on. Continue to step into these opportunities. Don't be totally passive, but just really be opportunistic in how you step into this market.
Yeah, we can sit up here, from up high and say 2.2 billion bushels of corn on the balance sheet. Everything's going to be just fine from the buyer perspective. But, we're going to kill the corn crop 3 times between, Easter and harvest, right? I mean, it'll be too wet, too dry, too hot, too something. We always go through those moments. And so maybe you don't want to be white knuckling every one of those rallies, right?
Amen. Amen. Well said.
Katie, anything else? We've been talking about farm protests in the EU. That's kind of interesting. Anything in the wider world of dairy and milk production that catches your attention?
Yeah, I think those EU farm protests, to build on that, have been really interesting because of their potential long-term impact on prices globally. So one of the things that has been happening in Europe is that they're facing a lot of environmental restrictions. The dairy producers there, along with others, are saying, hey, you're really hurting our livelihood and pushing back a little bit. And at least in some instances, perhaps that could mean a slight policy change. So I think as we think about the world globally, we are struggling a bit with demand right now internationally just because China is not buying as much. But if Europe can start making a little more product again, I think that changes our intermediate or long-term outlook. And I don't know, the other thing to focus on right now is just, keeping tabs on what's happening with global demand. Because while I talked up front about playing a little bit of defense, if demand picks up globally, there could be reason to be excited about milk prices later this year. We just don't know how it's going to play out right now.
Yeah, that demand, it could just come and go. It could come back and you would know it after it already happened, right? It's hard to see it coming.
And I think the interesting thing to piggyback on what you said, Katie, is while we're saying let's play defense, whether it be for grain sellers or whether it be for dairymen who are selling milk, that isn't necessarily saying, hey, let's go sell everything today. It's really about getting a floor underneath of this thing, and should better opportunities present themselves, we are absolutely ready to take advantage of it. And so I think that's one thing that's really worthy of highlighting. You don't have to go sell it all today, but you do have to draw a line in the sand to really be in a place where now you have paid for the opportunity to be patient.
That's exactly right. Manage risk and sleep better at night.
I don't think we could have better words to end this episode of the Grain Feed on. And so that's going to be a wrap for today's show. Thanks to the stats crew at Everag Insights for the data and graphs. And thanks to Everag Media Team for making us look good. Last but not least, thanks to our viewers for tuning in. As Jim likes to say, we love your feedback. Contact information is on the screen. Thanks for joining us.